Welcome, everyone. I'm Angelo Robles, host of the Angelo Robles podcast. I'm also the founder and CEO at Family Office Association. Today's session is titled Family Office Investment Committees, Helping to Bridge the Gap. Now, per that title, this is going to be most applicable to significant families, probably that have a family office, but in theory, this applies to many families of wealth that invest and even institutions. And even if you're still up and coming in what you're doing in investing, the strategies you'll learn about and getting outside guidance, assistance, mentoring, whatever verbiage you want to use, it still is going to be of value to you. We have a very special guest in Bill Kennedy, CFA. He's the CEO and CIO of RiskBridge Advisors. He's a little extra special because he happens to be in the great state of Connecticut, as I think many of you know. It's my state as well. So Bill, welcome to the show. It's a pleasure to have you on.
Thank you, Angelo. It's great to be here and appreciate the invitation.
Well, we have lots to cover. And why don't we start, rather foundational? Explain from your perspective, what is an investment committee?
Well, an investment committee for an institution is responsible and has the fiduciary duty to manage the assets of that institution, whether it's an endowment or foundation. For a family or a family office, which we would consider a medium-sized institution, it's the exact same thing. What are the governance practices, the policies, the procedures, the decision-making process that should occur to ensure that those assets are being well managed and managed in line with the mission and the vision of the family itself?
And in terms of probably more so from a family or family office side, what are the kind of people that could be involved in an investment committee? It could be a family member, a CEO, a CIO of the family office or investing aspect of the family foundation, but that probably sounds a little insular. Do they often have outside professionals that would make up the committee?
Typically they do, and we would argue they should. So any trusted advisors could be a tax advisor, an attorney, investment advisors. I have served on a number of family investment committees with other investment advisors who bring their ideas and perspectives to the table. But in general, it's to help think about first and foremost risk and the risk factors and the risk gaps that need to be addressed in the investment process, and then looking for those opportunities and making sure that that decision-making process is and sound and well-founded on a reasonable basis.
And we'll get to some of that in terms of, again, primarily from the family office side on investments and decisions, but staying with the committee format, part of it's going to depend on whether it literally decides for sure on investment direction and execution, or is more of an advisor to the family and the family office. But I'm assuming it could often be an odd number. And is it most commonly 3 to 5 participants?
3 to 5 typically works. Most of the committees I have sat on have been at least 5. In one case, it has been as high as 9, but an odd number to always be able to enable that tiebreaker if needed.
And I'm assuming sometimes when it does make specific decisions on at minimum direction, if not actual execution, it could vary, but it could be majority, it could be complete consensus. What do you kind of see as the most common?
The most common in the family office is gather up all the great ideas from around the table, but the patriarch, or in some cases, the matriarch, is the final decision maker. And so some governance structures will be a majority vote, but in many cases, particularly small families that are used to controlling their decision-making in their private businesses and other endeavors, they may hold the ultimate control, but having that committee provides that governance framework to help them in that process.
For sure, and especially for family offices, especially that are real pure family offices with non-family members that are active, at a significant basis in the family office, having an investment committee for governance and other perspectives is very, very important. We'll probably get into a little bit later, besides some of the key participants that I noted, kind of building or choosing the right people to be in the investment committee. What should be their tenure? Should they be paid? I mean, there's lots of different questions that we're going to have, but I did want to set a little bit of a foundation. Why don't we go a little bit into an overview of the governance models for single family offices specifically in their investment committee? What are some options they could potentially choose from?
Well, I think the foundation always starts with a very simple question: whether a family office requires an OCIO or an investment committee. To answer that question, you need to ask the right question about governance. Tell me the governance issue you're trying to solve, and I can tell you whether or not an investment committee is necessary. Many times it's not. Many times the family's looking for simply better returns, maybe more advantageous fees on deals and transactions that come through. Investment committee is not really needed for that. But when there are gaps to be filled, and we typically see three particular gaps. The first one might be what we call the gap between enterprise risk and investment portfolio risk. So enterprise risk, if the family has a controlling stake in a large enterprise or a company, what are the implications of all the potential risk factors for that company and how that might impact the investment portfolio itself? The second gap is thinking about one I'm sure many of our participants are familiar with, which is the generational gap. What if the assets are multi-generational in nature? The G1 or G2 might have a lower risk tolerance and risk appetite, whereas G2 or G3 or G4 may have a higher risk appetite. That's a great scenario where an investment committee can add some value. And the last gap is just skill and experience, especially in risk management, and being able to bring a variety of portfolio risk management skills, investment risk management skills, or even enterprise risk management skills to the table can be valuable. And in those three cases, anytime that the governance question is trying to cover or bridge one of those gaps, we would suggest that an investment committee may be the right approach. So with that, we generally think of three types of governance structures for an investment committee. So the first is a fully outsourced model. A RiskBridge or any OCIO firm will come in. They control the governance, they control the investment committee, they control the investment decision-making. Everything is outsourced. The endowment model, the second model, is a little bit more frequently used by families. And this is where the governance is typically held and controlled by the family, but they need some assistance. They need that guidance to implement that governance structure. The investment committee typically will include a family member or a group of family members, but also those outside advisors that we talked about. And the decision-making can be either majority vote or advice to the final decision maker, but in a committee framework. The third model is what we would deem to be the fund model. And in the fund model, that is where a family has actually created the legal entities to manage all of their wealth inside of trust, inside of actual LP structures. And typically in that case, the family controls all the governance, all the investment committee and the decision making, but they may bring in outside counsel and trusted advisors to be of counsel to the fund model. So I think most of what we will be talking about today in terms of the benefits of an investment committee for a family really goes to that second model. It's that endowment model where governance and the committee and the decision making is a shared responsibility.
For sure. And let's stay on that in terms of the long-term benefits of effective governance for a family office. Defining governance most simply is how decisions are made. If you could walk us through a little bit of some of the key points of that value of having governance. And again, what effectively comes down to how we make decisions.
So there, I think, are many benefits. One that the marketing staff like to make sure I emphasize is the fact that it really can help align the decision-making process to the vision and the mission of the family. I've said it, but I have to tell you, in my experience, having done this for several decades, I have yet to find a family that really wants to focus their investments on that mission and the vision piece. Typically, what they're trying to do is formalize the institutional decision-making process. And so how do you get away from the coffee table or the kitchen table and bring in the outside expertise to make sure you're making institutional quality decisions for the family's wealth? A second benefit is that this can sometimes serve as a very important mechanism for succession planning. If a matriarch or a patriarch unfortunately passes, there's a decision-making body in place that can help to ensure continuity of the wealth and the wealth portfolio and all those decisions. And then the third benefit, and this one has been is very practical, and I have served in this role in the past, where a family may come and ask the investment committee or a member of the investment committee to actually be the vetter, the screener, the no person. All these ideas that float across the family's desk, they never want to say no to a friend or a business colleague, but it may not be the investment decision for the family. And so sometimes an investment committee can serve that function as the filter, if you will, between the plethora of ideas that may come across the table and trying to vet out the handful that might be suitable for the family. So besides those long-term benefits,
yes.
I think it's, Angela, also worth talking about some of the pitfalls.
Exactly.
And the reason for that is weak governance can really destroy a lot of alpha. There's a very direct connection. And so I think the pitfalls are really 3 points. Number one, a lack of strategic direction can allow the family's investment portfolio to steer off course. And that's especially true in that situation where there might be a death in the family or the decision maker changes. The second pitfall is a lack of investment discipline. And it's not that you're making bad decisions. I think a lack of discipline can cause a family to miss out on good investment opportunities. And so really trying to have a disciplined approach to the type of investment opportunities that present themselves, whether they are direct investments or in a fund structure, without that governance standard and that governance process, that can be very hard to implement. And then a very practical matter that comes into play is just speed. And in the investment business, sometimes speed wins, and being able to get to a quick decision and execution and application of an investment thesis is very important. So by not having that governance structure in place, sometimes ideas can just sit on the table or never get vetted or never come to a decision process. And so there are both long-term benefits to having the governance in place. There are certainly some pitfalls for not having the governance in place, and whether or not that investment committee is right for the family. That balance sheet, that T account, if you will, needs to be measured and discussed. But again, it gets around to what's the governance issue the family's trying to solve for.
All very good points. I'm going to really dive into some of the things that you mentioned from maybe a little different perspective, because I think it's important. The reality is most single family offices, even those that may have non-family members legitimately working in the proper structure of a family office, are probably not my experience as rigorous or institutional in their risk mitigation and their processes for investing as they could be. So the things that you're talking about are really ripe for things that could add value. But there are some things I do hear from, let's call them the CIOs of the family office. It's like, Angelo, I deal with the core family members. We, boom, we come to decision. And if I don't do the job, I guess I'm going to lose my job. But now you're talking to the family about becoming more rigorous and institutional, adding an investment committee. I mean, yeah, I'm going to be a part of it, but now I feel like there's an extra layer of decision making, which I would argue that may be a good thing. Yeah, there are some things you may need to be tactical and move on quickly. And maybe the investment committee and the principal, you have certain agreements with a little bit of leeway, or like an emergency, like here's this, we need a decision in 48 hours. But how do you massage a little bit of ego, a little bit of lack of proper structure and governance to have them realize the benefits of progressing to something that maybe it's a pinch more slow, but it's going to be more beneficial to everyone in the long run?
It's a great question. So I think there are two solutions to that. This is an additional bureaucracy, if you would look at it that way. But it can be a vital part of the process. And so, as an outsourced CIO, it's incumbent upon us to actually help drive the process. So in many cases, and I'll share with you a case study momentarily, but we have come in and actually run the meeting. We set the agenda, we took the minutes, we did all of the governance, the policy statement and the charter for the investment committee. We take all of that off the plate of the patriarch, right? So that part of the paperwork, if you will, of having this family investment committee, we provide that service. And I think any good trusted advisor has that skill and would provide the same. But it's a good point about having, decisions don't only show up on the third Wednesday of every month, or whatever the date of the investment committee meeting's supposed to be. And so having that process in place to make quick decisions on the fly, in some cases, where the investment committee can come together quickly, it's absolutely crucial for some families. Other families, not so important if they're not that active in terms of making material trades and on a more frequent basis. And so it just really gets down to that governance, again, the governance principle. What are they trying to solve for from a governance standpoint? I think the biggest benefit for the investment committee of having the investment committee is really bringing the analytical firepower to the table that the family may not have, or an alternative view that to the other trusted advisors around the table, particularly if it gets to talking about portfolio risk and capital market risk. I think that's the reward of that can more than offset a slightly slower process.
I mean, this does get complicated. There's lots of gray area. And, one family office, one. An example that I could give would be a principal that was a hardcore direct investor, made a lot of money, formed a family office, and with their, let's call it CIO, is very active in specifically unique direct deals. But they may start to diversify to some things that are somewhat more the endowment model. So you can make the argument in my example, sure, the principal and the CIO, who whatever is a former investment banker, they're going to do things differently relative to the direct investments. And they're probably not making 10 or 20 of them a year, even the largest family offices, unless they're doing really active in angel and earlier stage, don't do that. But that may mean a little bit of a bifurcation of the investing. Part of it is more structured institutionally as an endowment model, and that may have an outsourced CIO or investment committee. And maybe there is a Machiavellian presence to the principal and what they're doing on direct deals. So you must have to customize things so much because they're all different.
It's absolutely has to be customized. And just to talk a little bit about why RiskBridge was created. We believe in the OCIO space, there's an absolute need for small to medium-sized institutions, which we would include family offices in that group, to really have that customization. And you can't do that across hundreds and thousands of clients, right? You can only do that with a dozen clients or a couple of dozen clients. And so customization and tailoring the investment committee process and the investment process itself to what that family needs is paramount. And that's where that endowment model that I talked about, the second of the governance models, has a lot of flexibility, right? Sometimes it leans on the investment committee, other times it leans on the patriarch. The example that you just gave, I can think of one family that had the fund structure. They had actually created their own investment legal entities, very much focused on direct investments, but it's probably the same family you and I are talking about. They came to the conclusion that they had been so successful in their direct and illiquid investments. Now they needed a little bit of guidance on the liquid part and how to diversify towards that illiquid part. And that just happened to be in the fund governance model. Could have been in the endowment governance model as well.
Sure.
But you're absolutely right, Angelo. It's about customization, tailoring the solution, and bringing that risk and governance perspective to the family.
And, back to the value of having the investment committee, whether it's, again, usually an odd number, 3, 5, 7, 9, whatever. Okay, you got the family member or key investing centric family members, likely the person who heads up or is the CIO at a family office, probably recommended an outsourced organization or person like yourself. But okay, that's 3, maybe 4 people. You still may need some more. What are the kind of people that you think a family office should look at? Is it someone who's an economics professor? Is it a deep macro thinker? Is it a hedge fund manager that's now retired? What kind of people would make good choices for that investment committee?
Critical thinking, a nose for the markets. Not all economists have a nose for the markets. They have a nose for economic research, but not always a nose for the market.
Yep.
But just being able to bring that critical thinking and ask the tough questions. How does this investment align with the vision of the family or the mission of the family? Is it within the parameters of risk bands or risk tolerance that have been established through the governance process? It could be a capital markets person, an attorney. Having that tax expertise is absolutely critical. Thinking through tax structure and some of these investment opportunities can be very complex from a tax structuring standpoint. And I'd also say, importantly, if you're investing outside of the US, which we are big proponents of, you need to have some perspective on the European markets or the Chinese market or the Asian markets. So having an international perspective and insight, I think can be additive as well.
Really, really important. And part of the challenge that I think I've seen in small investment committees, usually 3, is it gets a little clubby. They don't want to rock the boat. I would be a bigger believer in, listen, we're grown adults. We have our own emotional intelligence, but to do the best job possible for the family, we need to have ideas and debate them. And sometimes debates do get a little argumentative. I would look at my perspective of, if you're believing this is going to be a value, I want you to be passionate about it. I want you to maybe say, okay, you're on board there, but we're not, but talk to us. Maybe we're open to it. Does people tend to be very sensitive? They don't want to rock the boat. They want to be politically correct. To me, I would not want to have that person on the investment committee.
Well, and that's where I think the trusted advisors who are helping establish that governance structure, very important that they also frame the debate. And because you're always going to have a member of the investment committee or more than one who come with their, I got a guy, there's already a built-in bias to the recommendation or to the decision process, or it's their favorite collectible idea of the month. And, it may or may not be the appropriate investment strategy for the family. And so part of that governance is to really help to frame the debate, frame it from a risk standpoint, from a return standpoint, from a liquidity standpoint, how it fits in with the rest of the portfolio, and what are the correlations with other assets. So all of that takes a bit of a Switzerland, if you will, on the committee who can provide that role. But I completely agree with you. Having divergent views leads to better decision, as long as those divergent views are constructive and try to put them within the proper framework.
Yeah, I mean, perfect. But the example that you're talking about for sure is a common one. Most family offices don't have big built out infrastructure. And even in public equities and other securities, they're not necessarily, well, we're Michael Dell's MSD. We're going to build out teams and spend tens of millions of dollars and be strictly all quote unquote public and non public company direct investors. That happens. It's relatively rare. Most are going to be a little bit of what I described earlier, more Machiavellian, a couple of direct deals, but effectively kind of the endowment model. We have a broad idea of our investment policy statement and allocation, but we need to choose managers that we feel is best in breed. And that's where the example that you gave is so true. I got a guy or a woman and okay, I mean, willing to take a look at it, but shouldn't we be looking at certain quantifiable metrics and a variety of different factors? But on to my question, I see this as well, that they do not have at least an updated and good investment policy statement that sets the parameters. And then followed with, and maybe during COVID with things being topsy-turvy, maybe their asset allocation strategy is dated. Strategic might have been great from 2010 to 2020. It may not have been so great over the last year, where being tactical might have been better. So how do you go from vision to mission to getting everyone on board to having updated risk mitigation strategies, investment policy statement, and asset allocation? I am throwing everything at you, Bill. I know it's a lot, but why don't I sit back and listen?
Well, it's one step at a time, but let me, I'll share with you our framework. So we always start with risk. We have no control over the returns of the market, but we can control the amount of risk and the types of risk that an investor should be chasing. And so taking the opportunity to revisit your risk tolerance and what that actually means. Is that a portfolio that has a certain VAR characteristic, a value at risk characteristic? Is it a 10 volatility portfolio or a 12 volatility portfolio? What are the risk factors that you're exposed to? And Angela, you just raised a great question. As we have gone from a decelerating economy, which we suggest started in late 2018, through the recession and caused by the pandemic, one of the biggest things that has changed strategically is the beta play is over. The outperformance of the ETF world and just pure beta index investing, we believe, is changing. And what drives that is not a narrative, but it's just the math of looking at cross correlations in asset classes and within assets. And what we are finding is that we're probably in a very interesting environment now where active management should have a pretty good chance of outperforming. Don't know if it's going to last a quarter or a year or 3 years, but we think there's a real opportunity here to add some value with active management. So if that's not built into the investment policy, or if the investment policy was built with an indexation frame of mind 5 years ago, 10 years ago, that's a perfect example of where now is a time to take a look at that policy and think about adjusting it.
Very good points. How frequently should an investment committee meet? Is it once a month, once a quarter, something different?
So I have been on institutional committees, meaning endowment foundations, that are quarterly. I have found that the family office investment committee meeting monthly is ideal.
I agree with you.
And sometimes it's not to talk about investments. we'll spend lots of time getting the agenda together, and then other topics come up. But what a great forum to help the family discuss another project they're working on, or a planning issue, or a related family office issue. So, but I think monthly is the right frequency for the family.
So the family principal is, of course, the family principal. The executive in the family office is getting paid to be in the SFO. As an outsourced CIO, you're getting your compensation. But again, like we discussed, there will be people outside of those three. You want high quality people, and financial incentives don't hurt. So sometimes it may be from a variety of different perspectives, but I'm assuming you're in favor of, for those others that I described, they need to be paid. How do you structure their compensation and their tenure within the committee?
You know, it's a great question. It depends on the family and the family's willingness to pay the other advisors. And in many cases, the advisors at the table are already on the roster, right? They're already helping
Right,
out
that's different.
with trust and estates. But if it's a new investment committee partner who brings demonstrable skill and expertise and can be additive, there are a number of ways that can be structured, where it's a retainer fee, which can be quite frequent. But I've also seen situations where the families have allowed co-investment opportunity, all right, the
Sure.
investment committee member to participate in a structure. And so there's some creative compensation programs out there to help in attracting the right type of talent to a family investment committee.
And I mean, talk a little bit, we covered some of it in kind of back a little bit to governance needs of a unique family office. We spoke about the participants, the principal, potentially the outsourced CIO, others involved, the executives in the family office, but maybe talk a little bit about the fiduciary responsibility and other, and even who's kind of quarterbacking or leading the committee, and should that rotate and change?
I think it can. And if I could just take a second, I'd like to just show a quick case study.
Sure.
Which I will put up on the screen. Hopefully that's visible to everyone.
Yes, it is.
Good. So in this particular case, this was a family that had they're relatively young, had a liquidity event, and that led them to forming a family office, about $150 million of liquid assets. So they started off with a big institution, Big Five trust bank, 2 years. Patriarch was not happy with a number of things, but mostly he wanted more control of the investment process, and but his challenge was he didn't have sufficient resources. So in this particular case, which is a real example, which was referred in from the tax advisor, we decided to invest and actually create this investment committee. The rationale, again, what were the governance issue? The family office was too small to house its own investment team, but it was too big to make the decisions around the coffee table. So they needed a new custodian, because where they had been in the prior 2 years, the trust bank was also the custody bank. When they fired the previous advisor in the trust bank, they wound up with over 600 individual securities. So now they're trying to solve for two things. Number one, find us a home of safety and soundness from a custodian standpoint, but also we've got to deal with all these stocks and bonds, all these tickers and CUSIPs that are coming over. And the other issue we're facing, the patriarch had actually made a number of illiquid investments right around the time of the global financial crisis, and these were dated. And so it was 4, 5, 6 years on after the financial crisis, and all these illiquid investments were still illiquid, and trying to get liquidity and work with those fund managers. So we established the investment committee. It included the patriarch, the CFO of the family office, a trusted advisor, and me. And what we did was set up a due diligence process to go through all of the custodial relationships that were out there to try to find the best solution for this family. Secondly, we spent a lot of time trying to figure out a way to handle all those individual securities. And so we did the portfolio analytics around that and really trying to figure out how to take a disparate portfolio and restructure it. And we were able to do that using a combination of sub-advisors and separately managed accounts. We found some new funds and index, and we actually also created a replacement strategy, which would effectively give an index exposure plus 200 or 300 basis points of tracking error without him having to sell any of the stocks in the portfolio. So it was tax efficient solution. And so, here's an example, Angelo, where there were 5 on the committee, right? So it was 2 from the family office, it was the trusted advisor, the CIO, and the tax expert. And everyone brought to the table their relative expertise to try to resolve these specific issues that needed to be resolved. Find the custodian, do the custody search, help in addressing the portfolio and getting it risk budgeted and allocated to the right strategic asset allocation mix, and then dealing with the alternative managers, right? The fund managers where capital was still locked up and working to try to establish a disciplined liquidation plan and manage those cash flows across the board. So I think that's a real life example. I don't know if it's this example, but hopefully it gives you and the audience a little bit of perspective on how an investment committee can work through a whole host of issues, not all of which are purely investment, right? They might be vendor related or service related or custody related in this case.
Absolutely. And maybe commenting a little bit from that last comment and perspective, it is more than simply the investment policy statement, the allocation, the risk mitigation, endowment, direct, who to choose managers, how to service them every year and make decisions. I mean, that alone is a lot, but there are other factors for a wealthy family. What banks we're using, who is custody? Is this the best option for us? What's their cybersecurity protocol? Are we concerned about being targeted, or the institutions we work with or managers we work with? What's the counterparty risk? Again, the family's already rich. I think they want to stay that way, and not having significant, downturns and taking risk that may not be understood by everyone. These are all factors that play into, I'm going to say, even the investment committee. And this is evolving as we talk.
Oh, I completely agree. And you mentioned cybersecurity. One of the top 3 requests that we are experiencing now from families who are talking about what are your governance issues. Cybersecurity is a very important one. So, from a vantage point, having a good, stable preferred partners who are experts in that field, where we can help do the vendor due diligence, present the family with a couple of options. They get to choose, but it's based on our vetting process. I think that's a very real deliverable of fiduciary duty. It's not investment fiduciary, but it's certainly from a family fiduciary standpoint, very important.
And how do you address, you don't see this in institutions for the most part, but you will see it in families, very unique asset classes, some of them personal passions of the principal. It may be cars, it may be art, it may be just a wine that does factor in. I mean, look at the math, that's kind of going up. Owning a sports team, things that are unique assets. How do you weave that in? It must be incredibly complex in terms of mitigating the risk. But how does that play into the overall investment policy statement, allocation, and decisions? Because there's fewer experts in those arenas.
You're absolutely right. And I'm going to pick on one of your previous guest, Mary Klein,
Oh,
who's
she's great.
expert in the art field,
For
and
sure.
working closely with people like Mary who can help bring a subject matter expertise to the table, but then also figuring out correlations of that asset class. What are the return streams? What do they look like in the last 10, 20, 30 years? Is there a measurable risk quantity, and are there risk factors associated with that? The risk factor exposure to collectibles is it's a new field, and I think it's a very exciting field, and it's something we're watching closely. We're not experts in this space, but it's something that we want to participate in, because I think the answer to your question is, if the family loves arts and cars and horses and jets and other things and sports teams, they should have a very clear understanding of how the rest of their wealth interplays. What's the dance that the sports team does with the liquid portfolio, and are there correlations between those two? And the effort of studying that, exploring that, and we're not going to have perfect answers, but you at least can come back to maybe have a slightly more informed decision as to what should go in the liquid portfolio, given what the collectible portfolio, what that looks like from either a return stream or a valuation process over a long period of time.
Yeah, and as we found out, although it goes back 12, 13 years ago in 2008, sometimes what we think is uncorrelated is not so uncorrelated after all, when things are really, really bad. It played out differently with COVID versus the financial collapse and crisis, but just something to be mindful of. It may be a little off topic, but it's been a little bit of a kick of mine lately, and you've seen my investment summary and some of my recommendations. I promised I would get it out by year end, and I did by 7:59 p.m. on 12/31 on New Year's Eve, where the more that I look at it in researching the families, and I don't know, maybe I have families that are spendthrifts, but they own, and I look at inflation as often a benchmark that many of them will use in their investment policy statement, et cetera. And I'm saying to myself, I mean, you're going by the government CPI, you're kidding me. Because if you're, and I'll exaggerate it, you got a home in Greenwich, you got a home in the Hamptons, those properties are not going up 1.9 or 2.1% a year. Some years they are, some years they go down. But if you look at the averages, those kind of assets of the super rich, racehorses, homes in London, the locations I noted, buying sports teams, if they're living a little bit of that high life, I personally think that their inflation rate could be closer to 10 to 15%. Now, when I have economists on, about half of them laugh at me when I say that, but the other half kind of agree. Maybe they think I'm embellishing that a little bit. What's your perspective about really drilling down to what's important to the family, what their spend rate is, and if it looks like it's a little on the high side and they're living a little bit of that lifestyle, and they do want to press the pedal, be a little more aggressive on their investing, and their true inflation may be higher, how do you address that in the work that you do, knowing that that may mean taking more risk?
It's a great question. My opinion is the existential threat to all investors today is zero interest rates. Yes, it's a low yield environment, but it's a low yield environment because the risk-free rate, the policy rate, is set at zero or in some cases negative. So that spend rate, and this is, I can speak to both families as well as institutions that may have by mandate, they have to spend 5% or 5.5% of the corpus. With a zero risk-free rate, then you put a term premium on that to get to your bonds, you put an inflation premium on that to get to your nominal yield, you put a credit premium on that for corporate debt, you put an equity premium on that for equities. As long as that risk-free rate is at zero, everything is going to be below average, meaning below historical average. And so helping to, and again, we're terrible forecasters. We have no idea what equities are going to do this year or the next 5 years. We know what they've last 30, and we do believe in mean reversion. But mean reversion starts with the risk-free rate, which was running 2.5%, 3.5% over the last 30 years, is now at zero. And so helping the clients understand that in this low risk-free rate environment, yields and returns on assets over the next 3 to 5 years are probable, not guaranteed, but it's probable that they're going to be below average. And how should we think about the mix of the portfolio to counterbalance that? And then how do we think about the spend rate, whether it's the 5.5% for the institution or the monthly budget or the annual budget for the family? It's a very, very critical question. It gets completely lost in the narrative of today's business news in terms of what we hear in the market on Reddit and GameStop and Bitcoin and the other things that are dominating. But what the global central banks are doing is creating an environment that is a complete asset liability mismatch. The assets being the yield on the asset portfolio today and what that means for future returns versus that liability of that spend rate for the family over the next 5, 10, 20 years. It'll change. And look, we're on our way to 2% on the 10-year, it would appear. It's painful getting there, but once we're there, that steeper yield curve, it's, in my opinion, that's a good thing. Having higher yields in fixed income will help to mitigate some of that asset liability mismatch on a forward-looking basis.
And a question came in from a live participant. It's a little similar to the one I asked the question before last, but it has some nuances to it. I'll read it. How have you made families comfortable with new investment types or asset classes? What type of education do you find most effective?
Great question, because we're getting lots of questions around the crypto space.
No kidding.
Shocking. And,
what a surprise.
Yeah, Angela, you should be in a couple of my client meetings. I need your help. And we don't know. It is on the crypto, we're not experts. We have a view, but putting in context for that family, here's how a new asset class fits on the efficient frontier. Here's what the expected volatility or risk profile looks like. Here's what an expected return or income stream may look like. And then doing a drill down on the liquidity components of that, which is, I think, very important. If you can convert everything into a yield, you can always compare it to cash, to public equities, to private equities, not to gold, but trying to convert things into a yield format helps in that education process. But it's thinking about risk first. Are you getting compensated for that risk? So the return potential we talk about second, and then going into the liquidity components, but also who owns it, or who are the buyers and the sellers? What is the market for this? And doing some deep dive into that component of it, I think can be value added for.
Yeah, I mean, I think that's a great answer specifically to crypto. Sometimes I hear too much of one extreme from when you don't have the proper knowledge yet in terms of, oh no, it's, we don't understand it, it's bad. Maybe a year or two ago, we might have been able to get away with that. I think that's not going to work anymore. That's a bad approach. But on the other hand, just randomly saying, hey, yeah, it's going up, it's so great. Yeah, you should put 5 or 6% of your portfolio in it without having some foundation of knowledge. And the people that are fluid, and I'm still a novice, but maybe not half bad relative to Bitcoin, crypto, NFTs. The biggest sale was actually today, decentralized finance. I would say, find the right people and resources, get educated, but don't look like you need to do that in a day or a week and give the wrong information. But don't maybe be a naysayer so quick either. It's definitely gotten attention, and pretty much at the point where I am in terms of what I do is I'm comfortable now with 1 or 2%, and I may uptick that. But worst case, if that were to all go to zero, I'll have a glass of wine and cry a little bit, but it's not going to be the end of my day. But if I had 10 or 15%, and that went to nothing, that wouldn't be a death kill. I hear you, but it would hurt a lot more. So right now I'm managing my risk by better educating myself, diving into it and being an active participant, and really limiting my exposure. Probably too much, but I'm not 22 anymore, so I want to be a little careful.
Well, and to whoever asked that question, thank you. It was an excellent question. The one thing I would remind, there's never a bad investment. There are only bad prices. So don't forget to think about price versus valuation and all of those component parts to make that determination whether it's a good investment or not.
And Bill, in taking it to the home stretch, why don't we kind of tie this all together? I'll give the floor to you. A little bit of, okay, a significant investor, a family office, or an institution that's listening in. I have my good friend from the Alaska Permanent Fund, Marcus, and others. So we have a little bit of an institutional audience. What would be a little bit of, here's the steps to take to kind of wrap it up?
Sure. So I would say, with regard to the value of either OCIO to an investment committee or the value of an investment committee, understand what your governance issues are. It could be generational issues. It could be decision-making issues. It could be expertise and knowledge issues. Have a very thoughtful conversation about that with the family or with trusted advisors. And once you map out what those governance issues are, then ask the question, okay, does it make sense to have a structure, a governance structure, an investment committee to help alleviate those issues? Because as I said, sometimes the investment committee is not the answer and the OCIO is not the answer. Sometimes it can be resolved, do it yourself. But if there's a complexity issue there, if you can solve for that problem, the answer will become very evident to you. From that, it's thinking about all the questions, Angela, you asked. Who should be on the investment committee? What's the right type of skill set and background? How do you have those individuals engaged, either employees of the firm or from a compensation standpoint? But my wish and the mission for RiskBridge is really to help institutions and family think about risk first and foremost. Think about the enterprise risk of the institution or of the family business or the family office itself. How does that gap or interplay with the portfolio risk? Think about the capital market risk that are out there, and try to utilize, if it's the right structure, try to utilize the investment committee to enhance and supplement all of your existing resources so that you can have a more robust and thorough governance and better fiduciary outcome, candidly. There's no guarantee that it's going to lead to better returns, but it will lead to better decision-making, and that preparation sometimes leads to protection, and it's that protection that leads to performance. And so I think that's, in a nutshell, what I think everyone should be thinking about with regard to this question about investment committees for family offices.
And Bill, for those that would like to learn more about you and RiskBridge Advisors, how could they do that?
Sure. We are available on our website, which is riskbridgeadvisors.com. I am on Twitter at RiskReport, at risk_report. And we do publish the Risk Report, which is a periodical. We talk about market activity, risk in the market, and kind of share some of our asset allocation insights. It's available to the public. Be happy to provide a copy to anyone who is interested, but that's the best way to reach us.
Yeah, you guys do such a great job. It's been truly a pleasure to have you on and talk about a subject in my hundreds of digital meetings I've not covered since COVID. So, really, it's been fantastic. Thank you very much for your time. And pardon me if you might have just left it, but for those that want to directly reach out to you, are you okay with sharing your email?
Absolutely. And sorry, that's B Kennedy at riskbridgeadvisors.com. Rolls right off the tongue. Riskbridgeadvisors.com.
That's easy. Great. And everyone, I'm Angelo Robles, host of the Angelo Robles podcast and founder and CEO at Family Office Association, a global membership organization dedicated to successful families, investors, and family offices. Check out our website, familyofficeassociation.com. The membership link is very easy. You'll figure it out. Hopefully, we provide enough resources. We've never been so active as during COVID, and we're just starting to do some tiny roundtables where it's a little more open, AKA Miami. But that will get much, much better, I hope, as the year goes on. So simply stay tuned on that. We're very active on social media. I'm Family Office on Twitter, Family Office Association on Instagram, very active on LinkedIn. And the one that I probably promote the most lately, and I think it's our best platform, is YouTube. Simply I'm Family Office up on YouTube. So go and subscribe. It's free. It's very easy. And I give away, if anything, too much on there. We may start to scale that back a little bit moving forward, but we hope you all enjoy it. Bill, thanks for being such a great guest.
Thanks, everyone.
My pleasure.